My specialty is permanent life insurance. This is a 10-minute PowerPoint on permanent life insurance. We're going to get through it in 3 minutes. So let's say you want $500,000 in death benefit. Most life insurance companies are going to quote you a premium that is the minimum amount you pay for it. I sell policies where you pay the maximum for it. Why would you pay the maximum for it? You get a death benefit if you pay the minimum, but if you pay the maximum, you get all these other goodies. There's lots of designs in this industry. I separate my practice to the 7 companies that do indirect scoring. What indirect scoring means is that you can take money out of your contract, but the contract keeps growing. Most life insurance contracts work like 401ks. You take money out of it, the money stops growing. But if you have indirect scoring, the insurance company keeps your money fully invested, and they give you a line of credit using the investments as collateral. It makes a big difference 5 or 10 years out if that money keeps growing than if it's not, as to how much money you have at retirement. So the IRS says if you go over this line at the top of the screen, which is called the MEC line, or maximum efficiency contract, your life insurance is going to be treated the same as a retirement account. You take any money out, you're going to get taxed on it. You stay $1 below that line, any money you take out of the life insurance contract while you're alive is tax-free. You will never go over that line by accident, because if my firm or any of the other firms I work with receive a check that would change the tax status of the contract, they will call you, email you, text you, and if you don't reply and sign a form saying, I understand I'm changing the tax status, they send you the check back. You don't have to worry about going over the line by accident. Why do you want to go up to the line? Well, you get all these additional benefits. Your money grows in the contract tax deferred, like a retirement account. You don't pay any taxes on the gains. But unlike a retirement account, you don't pay any taxes on the money coming out unless you have a Roth. Returns are fairly competitive. I always tell people to expect at least 5%. If you're lucky, you'll make 6 or 7. You can put a lot more money into these than you can put into retirement accounts. There's a lot of additional benefits, which I'll come back to. You can use this contract as collateral to buy property or to get loans at banks. It's a safe harbor. All your money in here is protected from all creditors, including the IRS. So if your business is going down, this is not a bad place to have money. Surgeons love these contracts. They get sued. Nobody can touch the money in the contract. There's a no loss provision. You're guaranteed that your cash value never goes down. This is a low risk investment. It's boring as hell. It's like watching paint dry. You can borrow against the money in the contract or use it as collateral at a bank, depending on which way you want to go. The advantage of borrowing from the insurance company is you don't have to pay it back. They will allow you to accrue the interest, and they will charge your death benefit for repaying the loan. If you want to pay it back, you can. I always tell clients in December, pay the interest so you get a tax deduction if you use the money to invest in your business. But if you didn't use it for your business, there's no need to pay it back at all. So you have complete liquidity use and control. And if you are a business owner, there's ways to get deductions for the premiums. This is where you keep your safe money. This is not the greatest return. This is not the greatest investment, but it's better than all the other ones out there that are safe. There are 3 downsides to a permanent life insurance contract. First one is you got to pass a physical. Second one is you have to be younger than 70 years and 181 days. You can get life insurance after 70 and 181 days, but it's so expensive, it's really not worth it. And lastly, the money you put into these contracts, they're not very available for the first 24 months. In the 25th month, over half the money you've put in the contract is available, and all the money you've put into the contract is available in a few more years. So you obviously don't put money in here that you need in a month or next year. But for the long term, this is a great place to keep your safe money. Okay, on additional benefits, I have a separate presentation for that. Okay, National Life is really rising in the ranks. 5 years ago, we were the 25th largest life insurance company out of 300 in the US. 4 years ago was 21. 3 years ago was 17. 2 years ago was 12. We're now number 7. We're the only life insurance company that has grown double digits 5 years in a row. Why? I think it's because this product we have is extremely unique. You can cash in the death benefit for 5 different reasons. And here they are. Obviously death, but you're not around to enjoy that. But you also can cash in the policy for any of these 4 reasons. Terminal illness. My best friend was diagnosed with lung cancer and he had 6 months to live. He fortunately got on an experimental drug from Regeneron, and his tumor has shrunk 90%, and it's been 4 years, and things are looking good. But he cashed in his life insurance policy because he had a letter from his doctor saying he had 6 months to live. He got 90% of the death benefit tax-free while he's alive. Chronic illness is the same definition as long-term care. It just doesn't have the regulations. So we can pay you the money instead of the long-term care facility. It's a dollar-for-dollar reduction on the death benefit. Critical illness means you missed some time at work. When I had my heart operation, they gave me the option of cashing in my policy. I didn't do it, but it was wonderful knowing that if I wanted to, I could have cashed it in for $300,000 of tax-free money. And critical injury means you're not going to be able to go back to work and work the same way you used to. So the bottom 2 are kind of a combined disability policy. And depending on your age and the seriousness of the illness, you're able to cash in anywhere from 30 to 65% of the death benefit while you're alive, tax-free. Now, this is not a disability and a life insurance policy. It's one or the other. But if you're fighting cancer or recovering from a stroke, I think having that money while you're alive would do your family a lot of good rather than waiting till you die to get it. And you don't have to be all or nothing. You can cash in half of it or a quarter of it, whatever, and leave the rest of the death benefit in place. We're the only company that offers all 5 of these options with no additional cost to the policy.
Rick, I think we might be
Some others out there
on our screens. Sorry, I just want to make sure you're on the right screen because for us,
okay. Thank you, Alex. Yeah, I changed screens. Thank you. So those are the additional ways besides death you can cash that in. Thank you, Alex. I guess I put everyone else to sleep. This is why I was excited to talk today about this. The IRS just changed their rules 2 months ago. The ceiling of money you can put into these policies without making it a taxable vehicle has been increased dramatically. And that's because the majority of the life insurance companies out there use bonds to fund these obligations, and bond rates have dropped enormously. So have dividends on the policies. National Life funds most of its obligations through what they call an S&P collar. It's very similar to some of the products George markets, but his is in his can go into retirement accounts or regular taxable accounts. This is a life insurance product. You have no downside risk. You can either get 2/3 of the upside of the S&P 500, or you can get the first 8% and then a small fraction of the upside after that. But there's no downside if the market's down. So our balance sheet's improved. We've actually had 2 upgrades to our credit rating. We're now A1A with AM Best, which is considered the toughest of all credit agencies, and that's 1 level below their highest. Most life insurance companies are experiencing credit downgrades because their bond portfolios dropped from a 7% return to a 2% return. This guaranteed income with higher cash value opens up some very interesting tax-free income opportunities for people that have this contract. So here's 3 quick examples. He's a 44-year-old business owner. He's killing it. He wants to have 90,000 plus in tax-free income when he retires. He puts $57,000 away starting at 44 for 20 years. The death benefit starts off at $1 million. Every year these policies pay dividends. The dividends buy more death benefit and create cash value. So after 20 years, his cash value is 1.9 million. He put 1.1 million in. At 74, it's 2.7. And after 20 years, he's done. At age 84, it's 3.7. So if he turns on the guaranteed income at age 65, he gets $91,095 a year tax-free for life and guaranteed. Now, I use a strategy with clients where you use the life insurance when your portfolio is down, but if your portfolio is up, you use your portfolio for income. The 70s was the worst decade of the last 110 years. There were 5 bad years out of 10. So assuming you need to go to the life insurance every other year, this policy would generate $209,000 every other year in tax-free income. Not bad for $1 million. And the way it works is every dollar you take out, the death benefit goes down. But on the guaranteed, the death benefit never goes below 15,000. On the every other year, you can run out of money, but that estimate assumes you die before the age of 120. The guaranteed goes on forever until you die. Here's an average middle-class person. Let's say they want to have a very tax-efficient retirement. All right. Let's say they don't want to do a 401k or a SEP because they got a lot of employees and doing that would be expensive. All right, put $15,000 a year into this contract. You got $300,000 in it. He can add an extra $100,000 on a final premium. Now these final premiums have doubled or tripled with this IRS change. So let's say he throws an extra $100,000 in the year he retires. He's now got a cash value of putting $400,000 in. The cash value is $616. If he wants the guaranteed option, he gets $43,494 for life. That's a 7% yield on the cash value, tax-free. Now he's in a 27% federal and Connecticut tax bracket. That's an equivalent to almost $60,000 tax-free. Now here's why this is really significant. If you're in the 15% tax bracket or lower, you don't pay taxes on most of your Social Security, and you don't pay capital gains on the first $120,000. So you can have almost a tax-free retirement here. Now, here's a real life example. There's a couple.
You're gonna have to fly through this one because you're a couple of minutes over.
It's be 30 seconds. They have an existing contract. They moved it over from Mass Mutual to National Life. You're allowed to do that, just like an IRA, move from one firm to another. Bottom line here, they're getting almost twice the income tax-free, and they are stretching out their remaining premiums over 8 years instead of 3. And they're going to wind up with more death benefit. There's no downside. They just got to pass the physical at 67, which they did. But by putting in the maximum amount on the last payment, they really goose the income. So this guy's going to get $95,000 in guaranteed income for life, or if he chooses the every other option, which got cut off this page, that's $203,000 a year tax-free. Probably put in total about 900,000 into this. 209,000 tax-free for life at 76. This couple, their mothers are still alive at 98 and 102. They're in good shape. They're convinced they're going to live to be over 100. So they're probably going to go with the guaranteed option. We're the only company that has this.
Sorry.
So I recommend all of you get anyone you know that has an insurance policy with a lot of cash value. It would behoove them to take a look at comparing it to swapping into one of these.
All right, thank you, Rick. If you have not done a one-on-one with Rick, please go ahead and do that. You're going to learn a ton, not just about insurance, but about a number of different things. So I definitely encourage you to do that.